All right, I want to be cognizant of everyone's time, so I'll just quickly get started. My name is Maria Durci-Russo. I'm the Investments Director for the Venture City. For those of you who may not be familiar with the Venture City, we are a new venture and acceleration model that helps diverse founders achieve global impact. We do that in a few ways. One is through a 5-month growth acceleration program where we help startups achieve product-led data-driven growth. It's kind of a one-to-one approach. And so we're constantly taking applications. So if you're interested, you will likely receive more information from that at the end of this through an email. But if you are a startup looking for help or know of a startup that might be a good fit for us, please definitely send them our way. In September, we were also hosting a week-long boot camp on product-led growth. So stay tuned for that and more information. Another way we do kind of help startups is through our venture capital fund, investing in early stage kind of seed and Series A level investments, software enabled companies. And then lastly, we do help startups and larger corporations through our consulting arm, which we refer to as business mindset. So I want to introduce today's speaker, Jess Schrademan, who's going to take it away and help you learn everything, or at least a lot of things you should know about term sheets. So Jess, I'll hand it over to you. Oh, one quick reminder, we will be taking questions throughout the session, so please make sure you use the Q&A feature located at the bottom of your screen. And thank you. Jess.
Okay, awesome. So just in case none of that was heard, I was giving a huge thank you both to Venture City for organizing this, and also Maria, to you personally. You are such a powerhouse in this space. You do so much for the startup community, and organizing and hosting and advising everything. You just do such a great job, so thank you. Just as a heads up, despite working with many tech companies, I myself am not always very tech savvy, so I'm going to try to share my screen here, and by all means, Maria, if at any time something's not showing up right, please feel free to let me know. So let's check this just to make sure this.
You're good.
You all can. Yeah. Awesome, thank you. So yeah, so as Maria mentioned, today we're going to chat a little bit about term sheets for early stage startups. We're going to focus mainly on what you can expect to see in the beginning stages of forming and developing and getting your startup off the ground and running, and also with when you're at the point that you have some traction happening, you're getting some attention, and you're kind of ready to take the next step to get into a growth mode. So, there we go. So just real quick, Schrademan Law, we are a Miami-based law firm for business and intellectual property. We work very frequently with tech startups. We've been doing that since the beginning, as well as creative professionals and nonprofits. Generally, we work with clients to develop their objectives, anticipate their needs, and execute strategies to enable them to get from early stage through growth into a place of sustainability and hopefully eventually to an exit. So not letting me go directly to the next page, so I'll just have to fidget with that. So as I mentioned, today we're going to go over some basics. What are term sheets? When might you use a term sheet? What are the different stages that a startup will go through when a term sheet might be useful, as well as some key terms in convertible notes. We'll also briefly touch on SAFE agreements, which more and more are becoming very popular. And then beyond that, when you get into something like Series A and you're doing straight equity financing, we'll talk a bit about that. We have some samples and some language that we're happy to share with you. And then we'll wrap it up with some tactics on how to negotiate your term sheets and talk with your investors, and a couple of resources. I'm sorry, folks, but that's not.
You might be able to use the arrow buttons to the left. Maybe?
Well, that's actually what I'm doing, yeah, but for some reason it's going line by line. All right, I will deal with that, or maybe this one. There we go. All right, so term sheets. What is a term sheet? Generally speaking, a term sheet is a summary of terms related to a potential deal that you might be working on. You can use term sheets for everything from a potential lease agreement to a potential partnership, but more importantly for the focus of this talk, in dealing with potential investors who are looking to contribute to your startup. So again, whether you are an early stage going through a family and friends round, or you're working with angel investors, or hopefully at some point even with VCs as you're in a bit of a later stage, term sheets are often a great way to focus the conversation, to identify deal breakers, so things that absolutely won't work for one side or the other, to hopefully be able to tweak those things to make them work. It's often used as a sign of stability and commitment from one side or the other. A lot of times, very early stage startups that are themselves actively looking for investors will go through the practice of putting together a term sheet for themselves, in part for the internal exercise of determining what do our projections look like for when the time comes for something like having a valuation of the company, as well as what are we able to give, what are we needing to receive, what do we already have in place. It's a really good exercise to prepare for your conversations with investors. It is certainly used as a tool in the negotiations, but oftentimes it's very helpful to go through the exercise so that you yourself, with your founders, with your advisors, can get a really good sense of where you're at, what you need in order to move forward. So also, sometimes there are third-party and regulatory issues that might apply to your company, particularly if you are a fintech company. You certainly have lots of regulations. Crypto tech companies also have sometimes not very exacting regulations because that's still a developing industry, but certainly nuances that might apply, and term sheets can be a way to communicate to your potential investors that you know what you need to be aware of, the steps that have already been accomplished to make sure that you are operating in regulation, and basically to provide confidence to your potential investors. Term sheets are generally not binding, though they can be. It happens. It's probably not the norm, but there are certainly situations where term sheets can be binding. And again, it communicates a level of sophistication, and for some, it's part of kind of the way that business happens. It's part of the custom in the industry. So not always, but often investors are familiar with term sheets and sometimes even expect them. So briefly, some common instruments that are used at different stages. And again, for purposes of this conversation, we're going to be focusing mostly on the seed financing stage, where typically you are probably raising from as little as 50K to a few $100,000 up to $1 million, and sometimes a little bit above $1 million. Most frequently, we are using convertible notes or safe agreements, which are becoming more and more popular these days. As I mentioned, it's basically a promise for future equity, similar to the convertible note with a few differences. And also sometimes at a seed financing, you might have investors who are confident in where you're at and where you're going, or you yourself might prefer to not use something like a convertible note or a safe because those are technically debt instruments, which I'll talk about a little bit more in a moment. So sometimes companies will just want to offer straight equity. So I have a company, it's a super cool company because we make a great product that the marketplace really needs. And I know that I'm looking for a single investor. I'm willing to sell up to 20% of my company in exchange for $500,000, done deal. So sometimes you might use an equity purchase agreement. As you grow and you look at something like a Series A or Series B and beyond, you're looking at a few million, a couple million and above. Typically, once you get to Series B and beyond, you're actually looking at 5 million and above, not 3. That's my typo. And at that stage, you are probably looking at preferred stock purchase agreements, which include a whole lot more terms than what you will see in the early stages, as well as on some occasions, you might have a convertible preferred stock. So similar to a convertible note, but again, with more preference for the investors, more rights for the investors, typically a lot more complex. And you will see a difference in 2 sample terms a bit later. And then lastly, bridge financing. Sometimes you will see these at seed financing. They commonly happen once you're in growth. Sometimes you just need a little extra chunk of money to get to the next stage. You're not necessarily ready to go through an entire new round. Often you will look to your existing investors to fill a bridge. It's kind of a, as it says, sometimes a bridge of necessity. Like I said, you just need that extra little bit. Sometimes it's a bridge of choice. There's a great opportunity and we just need a little bit more in order to seize on that opportunity. All right, so average seed financing. So we're talking about seed stage. At this time, you might be just getting going. You've had your idea, you're developing the concept, you're testing the marketplace. It's very early. If you are a moonlighting entrepreneur, you might still have your full-time day job and you are staying up late nights to work on your startup company. You might be working on weekends, but at this point, it might still be either a great idea that you're trying to kind of feel out, or maybe a passion project that is developing into something more. Oftentimes at this stage, you will be doing what's called a family and friends round, or dealing with family and friends, not necessarily called a family and friends round. In some instances, you might be working with angels, angel investors. Typically, they are high net worth. These are individuals who, lucky for them, they've got a whole bunch of cash that they can use at their discretion. And oftentimes they are looking for new, young, excited companies and entrepreneurs who have a great idea, but don't necessarily have the financial means to develop them as quickly as the market might demand or opportunity might demand. And also, again, these people, the entrepreneurs, might have great ideas, but because it's a new idea, they're still working their full-time job. Maybe there's an opportunity to commit fully to the new tech company. So again, typically around $50K to $1 million, oftentimes a little bit above $1 million as well. Number of investors might be limited. You might just be working with a few. Not to say that I haven't seen seed stage rounds that have a dozen investors, because that certainly happens. Oftentimes a company might go through a restructure a little bit later down the line to clean up capitalization tables, what we refer to as cap tables. And just oftentimes, because things are done in the beginning, not always with all of the best advice and counsel that resources will allow for. Sometimes things aren't done super smoothly. Sometimes we end up with 20 investors who maybe have like 5,000 here, 10,000 there. And we might come to a point in time later down the road where we do a bit of a consolidation. We can talk about that later. And if anybody has questions about that, I'm happy to answer those. All right, so common terms, and again, I'm gonna focus mostly on convertible notes at this stage. I will talk a little bit about safe agreements, but because the two are very common, I'll spend more time on convertible notes and provide some of the distinctions with safe agreements in just a few minutes. So a convertible note, typically, for those who don't know, just real quick, convertible notes are a debt instrument. So what does that mean? So it's essentially kind of a fancy promissory note or loan agreement between a company or an entrepreneur and the investors. These are often used because, again, my super cool company, we've just gotten going. Maybe we've been working on things for maybe 6 months, 8 months, maybe around a year. So we're developing our product. We are testing our marketplace. We're definitely doing R&D in the marketplace amongst consumers. But because we are not really up and running in the marketplace, maybe we don't have a whole lot of revenue, a whole lot of users, or a whole lot of traction, it might be difficult for us to say definitively or confidently that the super cool company is worth right now $750,000 or $3 million, whatever that might be. Because typically these definitive valuations, we can come to those as we have a lot more data, traction, information, and progress with our company. So in the early stage, we will often use something like a convertible note that basically says, you, investor, are essentially loaning me, the entrepreneur, money with the hope and expectation that within a certain amount of time, we are going to be up and running soon, hopefully. We are going to have more traction, and hopefully we soon, again, are going to be at a point where we can do a larger financing. Oftentimes that's a Series A. We refer to that, and I will refer to that here, as a qualified financing. And then once we get to that point and we are dealing with more sophisticated investors, an angel or a VC, something like that, we have more data and information in order to determine what the value is of our company. And at that time, the hope for our convertible note holders is that the money that they have lent to me in the beginning is going to convert into equity of the company so that they become owners of the company. So it's really, it is a debt instrument in terms of there is a maturity date, so that's the term, and kind of in a less than ideal scenario, but one that happens is upon maturity, I will return to you your money, oftentimes with interest. For early stage startups, interest typically ranges about 6 to 9%. I have seen a little bit less, I have seen a little bit more, but that's kind of the industry standard. So my note holders, you the investors, you kind of have that backup plan in the event that we don't get to a conversion event, which is something like a larger round or a corporate transaction that results in a change of control. Maybe we merge with another company or partner with a company, or maybe we just get right to it and we get to an IPO or an exit or an acquisition. These are all conversion events. And this is the hope and the goal for our note holders, that that will happen, which would trigger a conversion event, at which point the loan amount gets converted into ownership of the company. And when we talk about the conversion event, that is usually based on a conversion price. And let me just check if I have more on that. Okay, so I'll stay here. So the conversion price, and I can actually show you all. So this is a sample term sheet for a convertible note. You will see here it's titled a convertible promissory note, because again, this is a debt instrument. It is a loan, so it is based on a promissory note. So in this situation, for our super cool company, we have structured conversion, as I mentioned, to happen on a number of triggering events, like a qualified financing. And when that happens, because you, the investors, really took a chance with us in the beginning, we want to thank you. We want to make sure that you have a good return on your investment. We want to make sure that the upside is very promising for you. So oftentimes, most of the time, we will offer an option. So either, let's say that at our qualified financing, the amount of money invested when the math is done brings us to, let's say, $100 a share in our company. But because you, the investor, have this deal with us of the convertible note, we are actually going to discount that price per share for you. So in this case, we've done a 20% discount, meaning that when the new investors are paying $100 a share, you are going to only pay $80 a share. Unless another calculation, which I will get into in just a moment, gives us an even less price per share for you. Because again, the point is we want to thank you. We want to give you the benefit of the upside and of the risk that you took. So we're going to offer you the lower price per share. And the alternative way that that can be calculated from a discount is what's called a valuation cap. So basically, we say no matter how much money we actually raise, we are going to cap the value for purposes of determining your price per share at $1 million or $3 million, as we have done here for the super cool company. So based on those two numbers, the 20% discount on the new investor's price per share, or what the price per share would be like if we capped value at, in this case, $3 million, we are going to give you, our first investor, the benefit of that equation so that you will pay basically the least amount per share possible under this arrangement.
Jess, quick question. Actually, two quick questions.
Please. Yes.
One, will we be distributing the slides?
We totally can. Absolutely.
Okay.
Yeah.
I'll make sure to include that in the email after this. And then
Sure.
For convertible notes, what happens if at the maturity there is no triggered event and there is no capital remaining to pay back the loan?
That's a good and tough question, but a real one. It does happen. So, and this question about what happens at maturity, that is where or why Y Combinator recently developed the SAFE agreement, because the SAFE agreement avoids that situation where the maturity date has come and gone and there hasn't been a qualified financing. But to the point, Maria, that you were asking, what happens if we get to maturity and the company has no money? So I unfortunately have seen this situation happen. Often, well, I won't say oftentimes, but in one situation that happened recently that I'm thinking about, we got to maturity, or the company got to maturity, and we had to have a whole conversation with our convertible note holders. This was an example where the company did have a number of note holders. I think there were 8. I believe there were 8 different note holders. And each of those note holders, to the benefit of the company, did have some experience in the industry, familiarity with startups. So those conversations were at least familiar to be having, which might be different if, for example, you're doing a family and friends round, where maybe those individuals aren't so familiar with this process. But so in the situation that I recently handled for a client, we had to have a number of really tough conversations with the board of directors of the company, as well as the note holders, because even though at the time they did not own any part of the company, they did own a debt of the company, or the company owed a debt to those people. So we had to have a really hard conversation about, do we do a bridge round in order to get more money, give this some more time, and hopefully achieve our milestones and our objectives? Or do we need to say, you know what, we did the best we could, maybe the market demand isn't what we thought it was, or maybe our competition is much tougher than we thought it was, or maybe we just really underestimated the amount of resources that we needed, and now our current note holders and maybe the team itself doesn't have the risk tolerance to maybe put in another double that amount of money. And you have this conversation, and it will definitely depend on your specific circumstance, but together with your board, and also out of respect for your debt holders, conversations with them, you will have to make that decision of what is best for, of course, for the company, but more importantly, for our stakeholders, because really at the end of the day, we have to make sure that the people that are putting their trust in us, that we take care of them. So again, that's a conversation you have to have. I recently actually have had two startups in similar situations. One of them has gone through a couple of bridge financings. They really believe in their idea. Their investors really believe in them, and they are willing to essentially buy themselves more time to make more progress. In another situation, which was less fantastic, I will say, the CEO of that startup, who was a founder, was removed as CEO from the company. The board installed a new CEO. They made some structural changes to the corporation, and they are also moving forward, but it looks very different from what it did in the beginning. And then, of course, there can be even less than ideal situations where the best business decision is to say, you know what, we gave it a go, it's not working, let's dissolve the company, and, you know, failure happens, let's try something new. So that definitely does happen. Maria, are there maybe any follow-up questions to that?
A few. So one question
Sure.
is if seed investors typically have a preference between convertible notes or safe documents, or does it really vary on the company or the investor?
Yeah, so what I am finding is that it kind of depends on who the investors are and how familiar they are. So again, safe agreements are a relatively new invention that came out of Y Combinator. For those who don't know, Y Combinator is a very well-known and respected accelerator program out in California. Some of our own Miami companies have been participants in Y Combinator, and they have a great team of their own attorneys and advisors. And so they've created the safe agreement that, as I mentioned, it doesn't have the maturity date and it doesn't have interest. So kind of what that does is it just takes one less thing away from people to have to think about, and it allows to focus on development and growth. And it kind of in these situations that I was just talking about, it also avoids the need to renegotiate in the event that you get to maturity and there isn't some sort of triggering event. But so what I find is really, it just kind of depends on who knows what. I am kind of getting on board more and more with the safe agreements. They are being used more frequently. I wouldn't say that they have yet replaced convertible notes. And also part of that decision will be the investor's tolerance, risk tolerance. Some people are willing to gamble a little bit, but they want to know that there is an end date. So at maturity, something is going to happen, whether they're going to get their money back or they're going to convert into equity based on some formulation. So it's really preference. I wouldn't say that that decision is not based on the type of service provided or the type of good provided or even it being industry specific. I really think it's heavily preference of the individuals involved in the transaction.
Okay, a quick follow-up. What
Sure,
happens
yeah,
if you
keep them
take...
coming. I love questions.
So what happens if you take a safe note and then you take a convertible note afterwards from another investor after issuing a safe note?
Sure. So I am of the philosophy that we should have the same deal across the board. Of course, if we do one type of instrument at one stage and another type of instrument at another stage, I candidly can't think of any situation where an early to mid-stage startup of mine or that I've heard of has done a convertible first and then a safe. Typically, we're working either with the same vehicle. Again, the caveat there is once we get into growth and we start dealing with preferred stock purchase agreements, those are separate. But as in the earlier stages, typically it's one or the other. If for whatever reason, and I haven't seen this happen, but if we are doing a second small round, let's say early stage round, and maybe the initial investors have a preference of changing the deal, then we could go through a process of corporate approvals and corporate documentations to make that change. Candidly, that's a lot of work to do. And if you are doing it well and working with advisors, your financial advisors, your accountant, and hopefully your legal advisor to draft the legal documents for this, it would probably be, you know, more money to do this change than it would be to just stick with one vehicle. And of course, the terms themselves might vary slightly from one point in time to another. But when you're doing let's just focus on a seed round, for example, with a single group of investors, typically they will all have the same deal. They might be investing different dollar amounts, but as far as the conversion triggers and maturity and the interest and all of that, their terms are going to be the same.
And then somebody is asking, we might have some European startups on here, and they were saying if there are any main differences between US companies and perhaps European companies. If you work with both, can you speak to that, or any caveats?
Yeah, sure. So because I'm a Florida attorney and I'm licensed in the state of Florida, my work is mainly focused in Florida, though the caveat there, of course, is especially in the tech world where much of the marketplace and business is done online and cyberspace. I definitely work with companies outside of Florida that have some sort of significant connection to Florida in one way or another. But as far as international companies, because, you know, state laws vary state to state, and certainly international laws and country-specific laws vary. I have not represented a company in its own country. I do often work with international companies that are coming to the US. I'm Russian speaking, so I have a couple of Russian clients, and there are a handful in the European Union, but most of the time the process is what they're doing in the US. So I can't really speak to country-specific laws, though I do know that international investors, particularly in Israel is a great example, the tech world is operating pretty similarly. So I am guessing, I'm not sure completely, but I would expect that deals are similar, probably even some of the language is similar, but I can't speak to country-specific laws. I'm sorry for that.
Thank you. Do you want to go on, or should I? There's a few more questions. I don't want to hold you up.
If there are questions, no. If there are questions, I'm happy to answer. As I said, you know, I think convertible notes and safes are probably where most people's curiosity are. So if there are questions, I'm happy to answer them.
Okay, great. So one question is, can you raise money as a C Corp under a convertible note while still employed at a full-time job?
Can you raise as a C Corp while still having a full-time job?
Under a convertible note, yeah.
And yeah, I don't see why not. Your corporation will hopefully be separate from you personally. If you're asking about a C Corp, then I'm assuming that is the case. So convertible notes, rounds, they can be done with LLCs, they can be done with C Corps, with S Corps. The tax structure of the company, and I really hope I'm not missing some nuance, but and it was a C Corp, right? The question is about a C Corp. Yeah. So yes, and C Corps are very common, especially some of you might know that Delaware is a very popular place to incorporate, and very frequently that's going to be a C Corp, so it can also be an LLC. I know of, and many of my clients, they incorporate in their own home state, whether that's Florida or Michigan or wherever, but Delaware is certainly a very attractive place for many new entrepreneurs and investors. But to the point about can you raise money under a convertible note while also still having a full-time job? So oftentimes that does happen because, again, remember that when you're doing an early stage round, you probably are still working full-time. And some of the hope, and certainly this isn't the predominant reason to do a raise, but for part of the funds that you are looking to raise, usually at least some of that is to allow the founders to focus more of their time on the startup. So founders will often, you know, when it gets to a good point, don't do it too early, of course, and unless you have super high risk tolerance. At some point, the objective is to leave your full-time day job and take on your new 24-hour day, night, weekend, holiday job with your startup. And oftentimes a convertible note can provide the funds to make that happen.
Great, thank you. Another question is, if you're trying to get seed money but already have some traction, is it better to be upfront about which vehicle you want to use or give investor the choice of equity, safe, or convertible?
So, okay, that's a great question. And I would lump convertible notes and safes together. I'll talk about those generally as debt instruments as opposed to equity, an equity agreement. So if you have traction, if you're a platform, if you have users, if you have subscribers, if you are selling products and you have revenue, if you are at a place where, and you maybe have projections that hopefully you have worked with your accountant or your CFO or some other financial advisor, if you have really solid projections and you know pretty well what the company is worth now and likely what it is going to be worth in a year from now, 3 years from now, 5 years from now, I personally, I don't like debt. I don't like, you know, owing people money. If you are in a place where you are good to go and you are just looking for, you know, an extra little bit and you know that you probably aren't going to need much more after that because that's really going to be your turning point to get to steady revenue, steady subscriptions, all of that. Maybe doing a straight equity round is where you are at. And that would be a conversation with your potential investor, maybe a couple of investors who might be silent partners in your business. And you're probably really going to get into due diligence at that point. You're going to show your projections, you're going to show the data supporting your traction, and hopefully you'll just be able to sell a chunk of your company for the money that you need. In the event that you have a little bit of traction, but you're still working on the beta, or you're still working on finishing the prototype and, you know, getting everything in place, but you're getting some good initial feedback. It looks like there's demand in the marketplace. It might be a little more difficult for you at that point to have a precise valuation. And that's often where the debt instruments, the safe agreements, and the convertible notes get used, because it's a way to avoid valuing the company without sufficient information.
Okay, another question is, from an investor perspective, a safe seems a bit more risky since the fund commitment is more open-ended. Does this typically impact the other terms of the deal they're willing to do, such as higher amount of equity or more visibility or influence in operations?
Oh, these are great questions. I like these. So it will probably depend on the level of sophistication of your investor. Again, and you're right, risk tolerance is a huge part of it. Again, convertible notes have the maturity date, so there is kind of a hard deadline. So whether, if we're talking about a safe, and actually this might happen with a convertible note just as well, is if you're working with a sophisticated investor, they might have their own requests. If it's a very sophisticated investor and you're doing a larger round, then you're probably looking more at the series rounds where you have preferred I'm saying I'm saying stock and shares generally. That's language that we use for corporations. You can do all of this with LLCs as well. The language is different. There is certainly a difference in the laws that apply slightly. But generally, just to let you all know, you can do it with an LLC. I'm just using corporate language for consistency. So if you are working with a very sophisticated investor at a series, at a higher round, there's going to be a whole lot more demand, expectations, and requests, like liquidation preferences. So going back to the question of what happens if things aren't really going very well and the company has to dissolve. Sometimes investors will have liquidation preference. If there are any assets to liquidate, they might get paid kind of in seniority. Participation rights, dividends, anti-dilution. So if I am an investor and I own a certain amount of equity, and let's say I'm investing a large chunk of money, I might require anti-dilution protections, meaning that my 20% cannot be reduced. And this is actually a good thing to circle back to in an early stage. Oftentimes your early investors, if you plan to do successive rounds, whether it's a debt round or an equity round, oftentimes early stage investors might get diluted slightly in their ownership over time. Kind of the positive way to think about that is it's better to own 2% of something huge than 20% of something very small. So dilution does happen. In later stages, your investors might require anti-dilution. And then there are other protective provisions and registration rights and all of that. But going back to the question, this applies both in early stage and later, are board matters. And sometimes in early stage, this might be something you want to offer to your investors. In other cases, again, if you're dealing with more sophisticated investors, they might request to either be on the management team, so whether that's your board of managers or your board of directors, or at the least, they might request an advisory role. So I included that here as a miscellaneous provision. So in an advisory role, having an advisory board is a great way for a new startup, a new entrepreneur to have people at the table who have experience in the industry or in business in general, or financial or regulatory, specific to what you're doing, or legal. Sometimes I sit on the advisory board for a number of clients. So that's something, again, you might offer it as a sign of respect or potentially as an incentive, or your investors might request it because even if they might not have a vote at the board level, they want to be involved. They want to know what's going on. They want to at least be able to voice their opinions and provide their experience and expertise. So that's certainly something that happens. I think that maybe I answered that question very robustly with more information than was needed. If there's a follow-up, I'm happy to answer that question. Maria, if there are other questions, I'm happy also to answer those.
Yes, another question around kind of the need for due diligence when raising money through a convertible note. Can you speak to how much of the burden falls on the entrepreneur, founder / startup in terms of making sure they're taking money from an accredited investor?
Okay, yeah, good question. So yes, when we are raising money, when we are accepting money, when we are promising equity in our company, I mentioned regulatory issues. This certainly falls under the SEC, the Securities and Exchange Commission. It's a federal agency. It is intended for consumer and financial protection, and there are filing requirements. Thankfully, especially for early stage startups, there are several exceptions, filing exceptions, and most of the time, startups are able to fit into one of those exceptions so that the filing requirements are significantly reduced. But certainly, you want to make sure that the people whose money you are taking know what's going on. So that doesn't necessarily mean that your investors have to have a net worth of $250,000 or above for an individual, but they do need to have information. And as far as due diligence goes, really you as the startup want to make it as easy as possible to get money. That's the goal, right? The goal is to create something innovative and to contribute to society and all of that, of course. But as far as operating the company and getting through a round, the focus is make it as easy as possible. And what we do at the law firm for our clients, we keep very, very organized files for our clients. So we always make sure that there is a very clean narrative of what the company is doing, where they started from, and to where they are now. So making sure that you have your corporate structure in place, that's the governing documents mentioned here on this slide, as well as your management structure. And if you have any intellectual property, whether it's trademarks or copyrights or patents, making sure that everything is very well documented, very clean, very organized, so that when you are having conversations with your investors, regardless of their level of sophistication, it is very easy to show them, this is what's going on behind the scenes. It's all very clean. We've done everything very carefully. Give us your money. Hopefully it's makes it easier to do that. To the point of whether investors are accredited or not. So under the SEC, certain exceptions do allow for investors to be non-accredited investors. But again, you want to make sure that these people, before taking their money, that they have information they need to ensure that they are making a decision that they can handle, basically making sure it's a risk that's not going to cause financial havoc in the event that things don't go so well. In the very early stages, so we have questionnaires that we use. We also include certain provisions in the deal documents, whether it's a convertible note or an equity purchase agreement. Oftentimes, we will also include it in term sheets that the investor is representing to us that they have the ability to make the investment. They've been provided the information they need. They've had the opportunity to consult with their own advisors, again, whether it's financial advisors, their accountants, or their own attorneys, basically to make sure that they know what they're getting into. And you certainly want to be candid and have those conversations, make sure that, as I said, you always want to look out for your stakeholders and do right by them.
Okay, great. And then in the scenario with a bridge round, does the convertible note stack on top of the current one, or is it added to the original note?
I've seen it done a couple of different ways, particularly if you are working with the same group of investors. Oftentimes, again, through proper documentation, I've done it a number of ways with my clients. In some instances, we have amended the convertible notes. So instead of executing a whole new convertible note, the company goes through the proper procedure to authorize amending the convertible note. Typically, we want to make sure that all the investors are on the same page. And usually, again, if things are going well, but maybe going a bit slower, that's an easier conversation to have. And typically, investors as a group are usually on board. So with the note holder's approval, because you can't change the terms of a deal that already exists without approval from the other side. So assuming that we have board approval internally, and we also have approval from our note holders, the simplest thing to do would be to just amend the existing convertible note, whether that means extending the maturity date or increasing the amount of investment. Maybe along with that, maybe we have to amend the amount of the closing that we had previously authorized. So amending is a good way to do that. I have seen a number of instances where maybe so much time has gone by, so much development has happened, and we do just go through a standalone bridge round. But they stand separate in that instance, and they might have different maturity dates, they might have different interest rates, they might have different terms, and again, they stand alone. So when the first one either matures or has its triggering event, that chunk of equity converts, and then later when a triggering event happens for the second note, then that chunk of equity converts. So it can be done either way.
Okay, and in terms of, yeah, you know, a lot of the venture community these days are focused on software-based startups. How should startups outside of kind of the software-enabled, more around the ones that have typically greater capital requirements or longer timeframes to profitability, sorry, how should this impact the founder's thoughts about what instruments to use?
Okay, so again, I see these instruments used all over the board. I don't think that it's necessarily industry specific. When you know that you require, let's say it's going to be 24 months before we can expect to really have traction, or before we can expect to be at a place where we can kind of raise our bar and do more sophisticated, higher level, larger rounds, then you plan for that. So with your convertible note, I have seen convertible notes that are for 24 months. That's not entirely uncommon. 18 months happens, 12 months happen. I just closed a round. I think they did it for 10 months. So it's a pretty short convertible round. So all of that will go into what the terms are of the deal that you are using. I wouldn't say that that would vary which of the instruments that you will use. Again, whether you use a debt instrument or an equity instrument will be more based on where you are at in your business. So, you know, how much traction, how developed is the software? Do you have an MVP? Is it ready to be tested in the marketplace? If it's earlier, you're probably going to be using a debt instrument. If you are already in the marketplace, maybe you're using an equity instrument. But again, this is also, it's not A or B necessarily. I think, as you can probably tell, there's so many factors that go into this decision. But if you are really trying to answer that question for yourself, I think the important question to ask is, do we have enough experience and information to determine precisely how much our company is worth today, and a definitive X dollars we need that will get us to where we need to be, and then we don't need any more, because at that point we should be becoming profitable. Based on that answer, you will go either debt route or equity route.
Okay, great. I want to be mindful of everyone's time. I know we have 5 minutes technically left.
Sure.
I mean, so we can save some of the rest of the questions for at 12 if anyone wants to stick around, but feel free to go back to the slides.
Yeah, that's, I mean, really, thank you all so much for the questions, because you just made it so much easier for me. I don't have to make sure that I'm telling people what they want to hear. It's really helpful to have questions. So thank you all for doing the job for me, really. We covered really quite a bit. I mentioned, you know, we already talked a little bit about what happens in the later stages with preferred stock purchase agreements. And I'm just looking at that little note on the side, getting them big dollars. I don't remember typing that in, but I'm glad it's there. I hope you all get to this point and that you are having to make decisions related to how much authority and power and rights you are giving to your investors. Because when you're at that stage, you're growing, you have traction, you have proof of concept, you might even have some revenue, things are going really well. So when you're at this point, it can be intimidating. It is intimidating even for myself as an attorney that works with VCs and investors, it's always intimidating because there's so much more at stake. There's so much more up in the air. And maybe the best advice I can give in this moment is make sure that you have advisors and counselors that you trust, who are familiar with the experience, who have been through this, so that they can really guide you through what all of these things mean. And also a lot of the job is providing the reassurance that you need to know that, yes, these are big things we're talking about, giving a right of first offer to our investors, that's ROFO at the bottom, or the right of first refusal to our investors, and maybe with the company involved as well. So, there's bigger commitment for sure. But if you're at this point, things are probably going really well. And oftentimes my job as the attorney in these situations is to make sure that my startups are comfortable making those exchanges, knowing that it's all for the end goal, and things are probably looking pretty good at that point. This is just a little bit more about each of those items that were previously listed. And so just for comparison, I included, you all might have noticed that the term sheet for a convertible note or a safe, this one is 2 pages. When you get to the later stage, you are looking at page after page after page. Keep in mind, this is just the term sheet. I believe this term sheet was 10 pages long. So again, make sure you have a team of advisors who you can trust to really walk you through all of this. We talked about bridge funds. That can be for, so these are 2 separate things. In the top left corner, we're talking about Series B. Bridge funds, we talked about all of this stuff. These are other points at which you might be using a term sheet. And maybe just a quick things about negotiating with potential investors. And again, this will very much depend on where you are at in your growth. If you are early stage, if things are really just picking up, you might not have a whole lot to offer in exchange for the risk that you are asking your investors to take. And that's okay. They get it. They know. And with you providing proper information and all of that, they will know what they are getting into. It's always important to do your research, both in terms of know your investors, know your market, know your competition. It's very important. The more you know, it's like a slogan, the more you know, or now you know, something like that. But the more you know, the more confident you will be in making these pitches and having these conversations. Have a team behind you. It can be intimidating, as I've said. If you have accountants, if you have an accountant, they can talk you through some of the numbers and the figures, of course. Maybe you have advisors who are experienced. One of my startups right now, their advisor board, I'm on the advisory board as the legal counsel. They also have a previous founder who started a company in, I believe it was the 90s, grew it, made it sustainable, exited it publicly, very successful. That person acts as an advisor to kind of bring, the industry knowledge and experience, firsthand experience, very important. Have the team you trust behind you, either to be at the table with you having these conversations, or to be behind the scenes to make sure that you are prepped for your conversations, to help you do any follow-ups after your conversations, and to keep things going. And with those 2 things, hopefully you will go in, you will feel confident, you will be prepared. And also being flexible is always important. This is something that comes up very often is, so I am a startup and I have a term sheet, and so this is kind of it, right? It's like, this is what I am looking for, this is what I'm offering, and that's it. That's not the case. Oftentimes, term sheets are used, as I mentioned in the beginning, as a means of facilitating the conversation. So you might do your internal due diligence and think, this is what we can offer and this is what we need. And then once you start having conversations with investors, you might get feedback from investors. They might have questions. They might have, maybe they have different preferences. And a term sheet can be kind of a living document that gets revised a few times to hopefully get to a point where we have the terms that we agree on, and then we sign it, and then we move forward to creating a definitive agreement. And I'm super glad that I mentioned that, because very important to distinguish that, again, term sheets most of the time are non-binding. They are a tool that you use to work out all of the kinks and get to all the terms, so that you then go and draft the definitive agreement, whether it's the convertible note, the SAFE, or the equity agreement. So be flexible, always important. And, so this is our 10-page sample. And here's some resources for all of you. A couple of local ones, Refresh Miami, which just does such a phenomenal job, Startup Digest, and Techstars, Y Combinator, Clerky, NVCA, which is the National Venture Capital Association. And then locally here, we have the Miami Venture Capital Association, which I have a very special place in my heart. That's kind of where I got my start. And PitchBook, which is a really great resource for kind of industry-specific data in terms of what deal flow is looking like, what numbers are looking like, kind of number-specific information. PitchBook, that's a new one that I have learned, I think, thanks to Refresh Miami, actually. Maria, thanks to you, which has been a really helpful tool for us, actually. And that's about it. So if there are any other questions, I'm happy to answer them, and certainly happy to share these slides. Our contact information at the bottom if anybody wants to reach out personally. I always love reconnecting with startups that I might have met in the past, and meeting new startups, entrepreneurs. Please feel free to reach out. We love meeting you all. So I think that's it for me, Maria. If there are any other questions, I'm happy to answer them.
Thank you, Jess. Incredible job. There's just like 2 or 3 left.
Sure.
So one question is, what are the potential downsides for both investor and entrepreneur of a straight equity at seed stage?
Okay, so if you're doing straight equity, remember it's a direct exchange. So it's 20%, for example, for $500,000. So, I mean, the downside, just like with any potential investment, is you might not get a return on your investment. Maybe things don't pan out the way that we had projected or expected. Investing is kind of like gambling. You have your resources, and you're picking which horse you think is gonna win the race. So there is risk involved, and certainly you could lose your entire investment. That's a reality. But the benefit, which hopefully outweighs the risk, or hopefully the risk is hopefully minimized because we are doing a killer job and things are going really well, you have the upside. So you don't have to worry about, thinking about, when is my investment going to convert? How much equity am I going to get in exchange for this? When is that going to happen? Who else is involved? Are we going to have to go through multiple rounds of this? There's a lot of thinking that happens in the early stage when we have more uncertainty. And so at the point that we have some definitive answers and we can do a straight equity purchase, we don't have to think about all of that stuff. It's, I give you X%, you give me X dollars. For the startup, one thing to remember is, once you give that equity, you can't really get it back. You have sold it. Of course, there are ways, and equity does get repurchased and things like that. But typically speaking, once you've given it, it's no longer yours. And also keep in mind that as an owner of the company, that person will have a say in certain business decisions that affect their ownership. So these might be big questions like, do we merge with this company? Do we exit? Do we dissolve? Do we take on more investors? So whoever it is that you sell equity to, make sure either that you structure the relationship so that that person doesn't have a vote, which is kind of a tough sell to make, I think, or make sure that the person you're selling equity to, that you trust their knowledge, their experience, their input, so that when it comes time for owners to vote on certain decisions, you know that that person's vote counts. It's very important.
All right, last question, so we can let you get back to all this legal work.
No worries. Oh, no worries.
Is it an understanding that some of the seed money is used for expenses related to company formation, drafting of SAFE, and any legal work done, or does the entrepreneur front those costs beforehand?
Yeah, so most often, before people are investing, they want to see that you have, you know, you're putting in time, of course, but also that you've put in some of your own resources. Certainly having the company formed, you should definitely do that on your own. In Florida, for example, if you do it with an attorney, you can get yourself incorporated, get your federal tax ID number, and open a bank account for $500. If you do it on your own, which you can online with Florida Department of State, they have an online portal where you can do your own filings. I think the filing fee for an LLC is like $125, and for a corporation, I want to say it's $75, or no, that's for a nonprofit. Corporations are also like $130 or $150. So relatively, I know every penny counts, especially in these days, but in terms of your business expenses, relatively small expense. So certainly form your company, have your EIN, open your bank account. You can accept money if you don't have a bank account. Most of the time, investors are also going to expect that you have the documents you need in order to accept money. So typically the convertible notes, the early stage documents, typically founders and, well, not necessarily the founder individually, but the company, the founder's company is going to be paying those expenses. One thing that investors often are prepared for, assuming that we are at that level, is that their funds will be used maybe for securing a patent or preparing deal docs for another level of investments, or expanding the team, maybe preparing your employment agreements or intellectual property agreements, you know, those sort of things. But the first couple of steps, just as a way to show that you are in it as well and you are serious and you are committed, typically the founder and or the startup company is paying for those expenses.
Okay, sorry, just one more question actually.
Sure, sure.
So can you confirm whether investors are treated like founders in future capital rounds and subject to the highest levels of dilution?
Repeat that one more time.
Are investors treated like founders in future capital rounds and subject to the highest levels of dilution?
Oh, so, well, it depends on how the round is structured. If it's very early, sometimes people will bring on early investors as co-founders. I don't always recommend it because really you want the co-founding team, you really want to have an active role in the company. As far as the dilution goes, oftentimes the first founder or maybe the first few co-founders, they are typically, depending on how they've structured their equity, they're typically going to take a hit to their equity, and most of the time they are prepared for that. Oftentimes companies will say, you know, we have 10% that we are giving to our early stage investors, and the remaining 80% is split evenly between, let's say, two co-founders. But we might structure things with our first investors that the next round, maybe only the founders are going to be diluted. More typically, all equity owners get diluted pro rata, so proportionately based on how much they own. So everyone's kind of diluted in the same amount based on percentage. But certainly, you know, dilution and anti-dilution is a conversation that happens a lot, and often it will just really be based on the deal that you are working out with your investors. Typically in the early stages, especially if you're doing like a family and friends round, or you're working with a couple of early stage angels, everyone's kind of going to dilute proportionately. But that's not to say that it doesn't happen, that even early stage investors get some sort of protection from that.
Wonderful. Thank you so much.
Yay.
And thank you for all the
pleasure.
attendees that stuck around. There's still the majority of you, so you could tell how engaged and helpful your content. So just a reminder, within the next 24 hours, you should be receiving the slides, a video recording of this session, as well as some more information and a survey to share with us your thoughts, as well as any topics you're interested in us covering in the future. So thank you all for attending, and we look forward to seeing you at a future event. And a big thanks to Jess.
Oh my gosh, thank you all. Thank you, Maria. And again, thank you everybody for asking the questions. That's probably the best part. So feel free to reach out. Thanks, Maria.
Thanks. Have a great week, everyone.
Talk to you later.